We've got Nilesh Shah of Envision Capital joining us this morning. Nilesh, thanks so much for taking the time. And your initial reaction, of course, we've had quite a few people come through and say that this is an important step. It's an important statement that has been made by the Indian Armed Forces, by the Indian establishment. And your reaction to how the markets have taken this?
Well, this is a befitting reply to whatever Pakistan has indulged in. So it's probably the most appropriate response, and maybe there would be probably even stronger measures from India as basically a response or a rebut. So I think, honestly, a great move by India and by the Indian Army, and hope that we continue to kind of give such hard-hitting responses to them. Clearly, the market too has taken this in its stride, though this was a bit of a known unknown that yes, India would strike, India would respond. So markets have taken it in its stride, and basically the market is probably having a view that the uncertainty is behind us, the event is behind us, and now let's get back into earnings, liquidity, flows, and some of the other positive macro developments, like the free trade agreement. So I think on the whole, the market also seems to have kind of moved on from where it was.
Then the question that arises is that if you have the opinion that you're going to stay invested for the long term and you want to participate in probably the best growth story anywhere in the world, how do you deploy funds, considering that you've seen a considerable up move over the last 1 month, perhaps India playing catch up with certain other markets? But are you comfortable with valuations as they stand right now, or do you say that we've reached perhaps a little uncomfortable zone in a few pockets, and how would you be deploying your money?
I'd probably say that we are in a fair value kind of a zone. And clearly, India has always remained expensive on a relative basis to other emerging markets or to basically world markets as well. And that's because the Indian economy has been growing at a higher pace. Corporate earnings have been growing at a higher pace. And most important of all, the way India has been fiscally responsible, corporate India too has been fiscally responsible with a deleveraged balance sheet and a very high ROE, return on equity and return on capital employed versus rest of the world. So clearly India deserves to kind of trade at a premium valuations. I think what's going to happen going forward is that basically both India's economic growth and corporate India's earnings growth will positively surprise us. And why I say this is because clearly crude, which has been our biggest challenge, clearly has fallen and is in a structural decline. That will lead to lower inflation, lower interest rates, lower cost of capital, which I think will trigger investments and will trigger earnings growth as well. So that I think is clearly the biggest driver. The bunch of free trade agreements that India is on the verge of signing or has just signed, be it the United Kingdom or potentially with the European Union by the end of this year, or with the United States maybe over the course of next 1 or 2 quarters, all of this is going to bolster India's global trade. And these are things which essentially are extremely positive. These are all early and nascent signs of India kind of sustaining a very, very strong growth ahead. So I believe that while the markets have moved up in the last 1 or 2 months, but probably on a 6 months basis, they're still kind of flat. And we are also going to see now a whole bunch of FII flows coming in. With a weaker dollar and stronger growth of India, you would also see that kind of missing link also fall in place. So on the whole, I believe that India's valuations are justified based on higher growth, responsible capital efficiency, and a very, very strong flow of liquidity from both domestic as well as global investors.
Okay. In that context, Nilesh, tell us about the companies and the sectors that you feel, based on the scorecard on earnings that we've seen so far, have surprised you on the positive side, because there have been a few surprises, a few situations where margins have improved, operational efficiencies have come through, and there have been surprises on the bottom line front. So where have you focused your attention?
So clearly, financials has been a very, very strong pocket in this earnings season. And when I say financials, it's not just the big banks. I'm also alluding to, say, the mortgage lenders, affordable housing financiers, payment companies. These are all who have done extremely well and have reported a very strong set of numbers for the quarter gone by. Second segment, which is done reportedly well, is basically alcoholic beverages. That as a segment has done very well. Hospitality has also reported some good numbers for the quarter gone by. Businesses which are proxy to domestic demand and building materials, like say for example the wires and cables companies have reported again good growth, good revenue growth, good margins. So there have been several sectors which have reported double-digit growth for the quarter gone by, and the outlook still continues to be very, very strong for them.
So, Nilesh, good morning, Hiral on this side. Uh, Great time to speak as well. Now, we've spoken about, what or where are the pockets of growth. Taking the India-UK FTA into consideration as well, lot of opportunities that do emerge. How would you look at the sectors with regards to exposure in the UK and any picks that could come in from that space?
Well, on an immediate basis, I clearly believe alcoholic beverages is a sector which is likely to benefit from the trade treaty. Over the medium to long term, textiles could be a potential standout sector. Clearly, the free trade agreement puts basically the Indian textile exporters on a favorable kind of a wicket. And along with the problems that are there in neighboring Bangladesh, clearly India is at a sweet spot. So clearly believe these two sectors are likely to benefit, one from even a short to medium term perspective and the other from a medium to long term perspective.
Okay. One last question with regard to the auto pack, and you've seen Tata Motors react on the downside when those auto tariffs came through in the US. Of course, since then, the company coming out and saying that it's restarted exports to the US, and this UK trade deal is positive from their perspective, assuming that you are going to be able to bring in vehicles that are going to be cheaper into India. So JLR benefits, I would think. Do you have a specific comment on Tata Motors?
Yeah, they would clearly, I think, yes. I think it basically gives a relatively easier passage to JLR to kind of come in and start to sell. And you're seeing that as basically a positive reaction to the Tata Motors stock price. Obviously, of course, the stock has fallen quite a lot. And that's also because on the domestic side, there is increasing competitive intensity. Pickup in demand for CVs has been relatively muted. So currently, of course, Tata Motors is not just about JLR. It's a combination of several other businesses, a few which are expected to do well. And then there's an impending kind of a demerger as well. So I think clearly on the whole, yes, the Indian auto pack should also be basically overall be fine. Clearly, the price points at which the other peers of Tata Motors operate at, they operate at lower price points. So to that extent, they don't have much to worry from this trade agreement.
Nilesh, thanks so much for joining us this morning. Pleasure speaking with you as always. And, as always, I look forward to the next chat.
Thank you so much.